Hello friends, I'm Sachin Trivedi. I am the fund manager for UTI Transportation and Logistics Fund. First of all, let me hope that all of you and your family members are safe and healthy. Today we are going to talk about UTI Transportation and Logistics Fund. As you all are aware, that this is a sector fund with close to around 85% exposure in auto and auto ancillary names and around 13% exposure to logistics names. All these numbers that I'm referring to and I will refer to in this video are all as of end February 2021. When we talk about performance of auto as a sector, BAC Auto Index has given close to 49% return in last 1 year, and it has outperformed broader indices like BAC Sensex by around 19% in last 1 year. However, when we talk about volume performance in this sector, the challenges kept mounting in this sector, and many of the subsegments have continued to decline in FY21 year to date. Uh, this remember this is on back of the sharp decline that we have seen in FY20. Now, in past, we have discussed reasons why there is a sharp decline in this sector, but in a nutshell, if I were to say, this decline has been largely on account of rise in cost of end vehicle on back-to-back changes in couple of regulation and cost increases. But at the same time, the income of the end buyer did not kept pace with this increase in the cost. Now, but when we look at the longer term performance in the sector, many of the subsegments have given high single digit growth in past in long term. We continue to believe that this long term growth rate in the sector should continue, which could mean that in medium term there could be much higher growth than what we have registered in last couple of years. Now, the reason for us to believe this long-term growth should continue is clearly low penetration in the low penetration of vehicle, and the second is that as the economic activity picks up, clearly this sector should be beneficiary of higher volume growth. The other reason for us to believe that when the consumer chooses to upgrade their vehicle or choose to add more features to the vehicle, clearly it results in higher selling price for the manufacturer. So the two driving factor in this sector is clearly low penetration, and second is the higher average selling price for the manufacturer. When we talk about the fund allocation as of February end 2021, we have close to 65% exposure in auto OEM names and around 20% exposure in auto ancillary names. Our exposure to auto OEMs have increased by more than 5% in last 6 months. And this increase has gone largely towards four-wheeler, CV, and tractor names. We continue to remain overweight in auto ancillary space. We clearly believe that higher volume growth should result in should be beneficiary for auto ancillary names. But at the same time, changing regulation and more features to the vehicle should be added opportunity for auto ancillary names. However, we have trimmed our exposure to a couple of auto ancillary names wherever the valuation has run ahead of underlying business fundamentals. We have cut our exposure in lead acid batteries, where we believe that with rising penetration of electric vehicle, the underlying business case for some of these companies could come under a challenge. As far as logistics space is concerned, we have underweight position and we have trimmed our position in some of the container-based operators. In logistics space, clearly we believe we prefer companies with low debt and the companies where they have a high long-term growth potential. In a nutshell, if I were to say, if the investor is looking to benefit from revival in auto sector, they should look to invest in UTI Transportation and Logistics Fund. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.